Good afternoon, everyone, and welcome to our mid-year webinar series. Shortly, we'll be hearing from Zered Osmani, manager of Franklin Global Trust. This is a trust that you may have known as Martin Currie Global Portfolio, but was renamed earlier this year. This reflects a reorganization at Franklin Templeton rather than a new manager, and Zed continues to manage the portfolio to the same quality growth strategy. Before we get going, please remember that if you'd like to ask a question, you may. You can put that in the box on the right of your screen. We have about 25 minutes or so for the presentation and then 15 or 20 minutes for questions. So Zed, over to you.
Thank you very much, Thomas. Good afternoon, everyone. Thank you for joining us. We've got a few slides that we wanted to highlight to you, notably in terms of where we're seeing interesting opportunities. But very quickly, I will highlight some of the benefits of the Franklin Global Trust and our approach. We are high conviction managers focused on quality growth. So we deliver high quality list of stocks, at the moment 32 stocks. Fundamental analysis is how we identify the stocks and capture them. We have a valuation discipline, which many of you know about. Portfolio construction is also key in such a concentrated portfolio, and we have an innovative approach to analyzing risk exposures through fundamental frameworks, which again, some of you will be aware of. And one of those frameworks is a thematic exposure, which we're going to go through. We give that truly global equity exposure. ESG is at the heart of our process as well, and we deliver the benefits of an investment trust with quarterly dividends, and the trust also has a zero discount policy. We wanted to highlight the three mega trends and get an update on where we stand on that front. As you know, the three mega trends are helping us focus on structural growth opportunities, looking ahead over the next decade, 2 decades, 3 decades. And there are three important aspects here. Demographic changes, future of technology, and resource scarcity are those three mega trends. There are overlapping segments around some of those three mega trends, which we're also trying to capture where there's valuation support. And what you can see here is a highlight of themes within each of those mega trends, which we list on the left and on the right, and which are color coded as well. And you can see from this assessment that we have a good diversification across the three mega trends. The larger the circle that you see here, the bigger the theme that is attached to that circle is expressed in the trust. So you can see very quickly, visually, some of the themes that we favor. And for us, it's a case of looking at both being fully aware of the themes that run through the trust, as well as being diversified across the mega trends and across the themes. And thirdly, to be able to identify themes that we might not have got exposure to, where we might want to do more research work, but we will only invest in the theme if the valuation is supportive. So we do not invest in attractive themes, we invest in attractively valued attractive themes. So let's have a look at the three areas that we favor at the moment. They are energy transition, aging population, and artificial intelligence. These are themes where there are seismic shifts happening with some sizable investment cycle coming through that creates the opportunity for us as investors. We're going to zoom in on the energy transition firstly. What we're highlighting here is some of the challenges of a world focusing on reducing or at least keeping a lid on rising temperatures. If you look at the policies and actions that have been pledged so far, we are heading towards a 2.9 degree warming by 2100. If you capture also the targets that are also aimed at, you're looking at 2.6. If you're also capturing pledges as well as targets, it's 2.1 degrees. In an optimistic scenario, you're looking at 1.9 degree. So the 1.5-degree target that is being flagged out there is still very challenging, even with the optimistic scenario. Our view is that human ingenuity should actually speed up that optimistic scenario. But what this highlights is that there is a constant need to remain focused on the challenge at hand and looking for opportunities to get to that transition. And if you look on this slide, the necessary growth of various fields within energy transition to reach that 1.5-degree target. Firstly, that pie chart shows you that the share of renewable energy has to go from 1/4 at the moment to 90% by 2050. And that renewable energy investment needed is therefore translating from spending $300 billion per annum currently to $1 trillion per annum. The energy efficient infrastructure, such as buildings in particular, the spend currently is $300 billion. That needs to go to $1.5 trillion to get to that target. And electric vehicle infrastructure, currently $2 billion gets spent on that. That needs to go to $131 billion. There's a typo there. It's $131 billion per annum. So you can see the sizable increase in investment needs, which creates the opportunity for investors. And for us, there are ways that we capture those. We're going to go back to some stock examples later on. Let's move to aging population. An aging population does require more healthcare infrastructure. So for us, there is also a revolution in the making in healthcare. What we highlight at the top of this chart is that 16% of the world population will be 65 years or above by 2050. And with an aging population, you have, sadly, incidences of diseases increasing quite significantly. In this instance, the example is the UK population, but it's very reflective of the global population. So if you look at things like diabetes, that is predicted to increase by 49% between now and 2040. For heart failure, that's a 92% increase. Cancers, 31% increase. And COPD, which is a breathing disorder, 37% increase. So you can see how all these diseases increases are significant, which really highlights the need for spending more on healthcare infrastructure. We don't have a chart here on healthcare infrastructure, but we're predicting the healthcare spend to increase steadily at a 5% per annum over the next 15 years, which creates that supportive investment backdrop in the healthcare infrastructure. Looking at, actually, that slide is here, sorry, and we'll come back to the other one. So 5% per annum increase in healthcare spending, and that's predicted to reach $7 trillion by 2031. We then go to artificial intelligence. So artificial intelligence for us is manifold. There's 4 themes that we highlight within artificial intelligence. One is metaverse and quantum computing. The second one is robotics and automation. The third one is cloud infrastructure and cybersecurity. And the fourth one is geopolitical and technological fragmentation. So here we're zooming in on the cloud infrastructure. We've put the cloud hyperscalers and meta capex combined. Here in light green is what they've been spending all the way to 2023. The dark green bar incrementally is what they have increased their capex to as the AI opportunity has materialized in the current of 24. And you can see that with 25 projections onwards, that capex has effectively doubled compared to what it was previously. And the combined additional spending over the 3 years that we're looking at here, 25, 26, 27, is over $430 billion. So it's a sizable investment, which is continuing to increase, which leads us to believe that that AI capex has longevity. And there are companies that are well exposed to it, notably in the semiconductor space, companies like NVIDIA in particular, which remains a big position for the Franklin Global Trust. But that to us is an important structural growth driver that we continue to predict will remain sustainable. Partly the reason why it's sustainable is this cloud infrastructure is being spent by cloud hyperscalers that are highly cash flow generative, profitable, and self-funded in the same way as Meta is. So we're therefore predicting a semiconductor super cycle that has been turbocharged by AI, and that's what we're highlighting on the left-hand side. We used to have a prediction of 8% annualized growth to the semiconductor market over a 15-year period on an annualized basis. That's what we call the super cycle. And the turbo boost that has come from AI has led to a 2.5 percentage point increase in our projections. We're now looking at 11% annualized growth to over the next 15 years. And yes, the semiconductor industry is cyclical. So what we're not showing here is a cycle, but we're really just keeping it simple and saying this is the growth on an annualized basis over that period. On the right-hand side, what you can see is a projection of robotics and automation growth to 2030. And again, that robotics trend has been supported or accelerated by AI. The compound growth, if you did the numbers here, would be about 15% annualized over a 10-year period. So again, very supportive themes feeding into that AI theme and leading to that semiconductor supportive and bullish view that we have. And for us, the semiconductor industry is an attractive area to be in because they are the enablers of the AI opportunity. They are parts of the industry that are highly consolidated with monopolistic or quasi-monopolistic positions, which means that these companies have high returns on invested capital, which we believe can continue to improve. And what we're highlighting with AI is that it has a potential to accelerate breakthroughs. In this instance, we're highlighting a protein. In this instance, it's named at the top. It's an unusual name, but AlphaFold is a program run by Google, which identified in a matter of months all known proteins to mankind, which is about 214 million proteins known to mankind. And the excitement here is that typically it would take a PhD student the whole duration of their studies, so 5 years, to unfold one protein. And that record unfolding using AI has already led to some breakthroughs. In this case, a protein with a potentially leading to plant disease resistance. We've had some proteins that are able to eat into plastic waste. Some proteins that have led to some antibiotics coming through, which again really highlights the potential for speeding up of breakthroughs that AI is already unleashing and will continue to unleash. So we've got a few companies that we wanted to highlight in the semiconductor industries, which the trust is actually very exposed to. We're zooming in on ASML as a leading producer of semiconductor manufacturing equipment. Its products are critical to the mass production of semiconductors. Its clients include some of the largest global foundries. It has exposure to the clean energy transition as well, because you need semiconductors for that. Electrification as well. But it's not the only stock in the semiconductor industry that we have exposure to. We have, as I mentioned earlier, NVIDIA in big size. We have companies like Cadence in the microchip design. We have companies like BE Semiconductors as well, which really gives us that big exposure to that ecosystem because of that bullish view we have on the super cycle turbocharged by AI. Then we wanted to highlight a company in the industrial space, Atlas Copco, as a Swedish industrial tools and equipment manufacturer. It is the world-leading provider of innovative industrial technologies. It's got broad client exposure, which leads to strong returns through the cycle. Yes, being in the industrial space, it is exposed to the industrial cycle, but what sets Atlas Copco out compared to many in the sector, in the industrial sector, is that this company more than covers its cost of capital, even through the worst of the crisis, such as the 08-09 crisis. And it gives us that ability to harness global infrastructure spend, but also semiconductor spending as a leader in vacuum technology, which is about a quarter of its business. Some of that vacuum technology is used in the semiconductor clean chambers to keep them dust-free. And again, the commonality between ASML and Atlas Copco is they're leaders in their fields. They have high returns on invested capital and exposure to attractive growth areas on a structural basis. Then in healthcare, we wanted to highlight Viva Systems. Viva Systems is a cloud-based software for the global life sciences industry. It provides mission-critical software for drug development and commercialization. It's got significant growth potential in what is an underserved market. And as we highlighted from that aging population trend, there is a need for more healthcare infrastructure, and Viva Systems is giving the ability to the healthcare industry to have some enhanced productivity, as well as harness data and artificial intelligence, which in our view should drive adoption of its software. And again, a high return on invested company with a very attractive growth profile. We wanted to finish our slides with a few areas of risks. We highlighted in our outlook at the back end of last year 9 risks that are listed here: monetary policy risks, fiscal policy risks, tariffs and trade tensions, which have really led to a very volatile environment and an uncertain outlook for the economic growth prospects, but also fitting back into monetary policy risks with central banks like the Fed holding back from cutting rates until they have more visibility on what the tariffs might be. The persistence in inflation is an important one. Our view is that tariffs do lead to more sustained inflation, which again holds back some of the central banks from cutting rates more aggressively, and that creates that risk. Corporate margin pressures are also going to be an important focal point given some of those tariffs. And geopolitical risks, flare-ups is something that we've been highlighting as a risk, and clearly that has happened, sadly, throughout various parts of the world, most recently through the Middle East. So an omnipresent area of risk. Lower long-term growth is still an assumption that we're making. And as a result of this risk, really what we're highlighting is that we want to focus on companies that have resilient business models generally. And the characteristics that we focus on when we're looking for companies to enter the trust are companies with high barriers to entry and dominant market positions, or the potential to be dominant, which gives them strong pricing power, which is critical in this period of higher inflation and sustained tariff tensions. Lower disruption risks in a world that will continue to remain disruptive. Structural growth prospects is important, looking at that 5 to 10-year time horizon. High returns on invested capital, which we've highlighted is a commonality of most of the holdings that we have. Strong compounding cash flows and solid balance sheets, and quality management and corporate culture. And at the heart of this wheel, attractive valuation, because valuation discipline is always critical for us. And we're going to finish with highlighting that AI accelerates the potential for breakthroughs. So we are indeed experiencing the start of a new techno-industrial revolution. The potential of AI to accelerate innovation remains underestimated by the market, in our view, and there lies the opportunity because there's a significant and accelerating investment cycle, which provides that significant structural opportunities we've highlighted in those seismic thematic shifts that we're favoring. At the same time, AI risks speeding up disruption. And that disruption can come from established businesses. And there are examples of very well-established businesses where barriers to entry are collapsing very rapidly. So it's important to focus on companies that will both monetize and benefit from the higher investment cycle, but that will also be able to stay innovative and stay ahead of any disruption risk. So it's important to remain focused on fundamentals as we do that assessment, coupled with valuation discipline in what will be a never disruptive decade that will continue to affirm itself. With that being said, we wanted to highlight for those of you who are interested in reading more about the stocks that are in the Franklin Global Trust, that we have an extensive library of stock ideas that we highlight through videos on our website. So please do go and visit that if you want to hear more about various holdings in our trust. And with that being said, Thomas, I'll turn back to you to moderate the Q&A.
Great, thanks very much, Sed. If you're in the audience, please do put your questions through. We've got a few, but we've got plenty of time, so please ask away. Perhaps we could start on the reorganization that I mentioned at the beginning. Could you perhaps tell us, Sed, what's different now that you've moved to the Franklin Equity Group?
Yes, absolutely. Thanks for that question, Thomas. Well, we're very excited about the move to Franklin Equity Group for many reasons. One, it's an alignment in terms of investment philosophy and investment style. Franklin Equity Group is focused on growth investing, and that's our approach, quality growth. And therefore, we're really looking forward to joining a group with over 60 investment professionals with whom we can share ideas, bounce views, and look at similar themes that we're invested in. The group is based in Silicon Valley, at the heart of where innovation is, and therefore that gives us a good access to companies on the ground, an ability to expand our coverage, our network of companies, and to get better access. Then we also have more access to research resources. Franklin Equity Group has over 30 career analysts who cover all parts of the US market, the US equity market being almost 2/3 of the global index, means that we will have waterfront coverage on a sizable part of the global universe, which will permit us to, again, tap into analyst knowledge. Analysts that have been covering those stocks for many years, as well as being able to fast track our own idea generation as a result. And finally, it will give us more resources in terms of access to brokers as well, all of which really makes it very exciting and something that we believe the Franklin Global Trust will be able to benefit from.
Now, with your growth approach, clearly assessing earnings growth is the first thing that you're thinking about, but how do you deal with valuation then? That seems to be one of the big risks with growth investing. Can you tell us a bit about how you ensure you're not overpaying for that growth?
Yeah, it's a very good and pertinent question, and will always be the case. So we have a very disciplined valuation framework. We have price targets, which we keep live at all times. They are using 3 valuation tools: discounted cash flow, which constitutes 50% of our price target assessment, economic value add, which is another 25%, and then target multiples is only 25% of the price target assessment. And actually, even price target, target multiples is based on year 5 multiples rather than 12 months forward. So with our valuation framework, we look to put a fair value on the business rather than what the market might be willing to pay over the next 12 months. That's the first point to mention. The second point is our discounted cash flow assessments use a very high discount rate as a threshold. We want to make sure that we have a high hurdle rate to look at an attractive upside to price target. And that's important. So just to give you a sense, we use a cost of equity of 9% for any company, no matter where they're quoted. The third aspect to mention is that, yes, as we're estimating companies' profits and cash flows and returns over a 15-year period, there is forecast risk. So we want to make sure that we have a good range of scenarios. We have a central scenario, but we're asking the analysts to also project a bull case and a bear case, as well as a blue sky and a dark sky scenario. And that's really that sense of making sure that we explore a range of scenarios so that we can have a good sense of upside and downside risks to any scenario. We ask the analyst to put a probability on each scenario, which also gives us some additional color around that. As a result, we will always favor a company who has a favorable upside versus downside risk assessment. Finally, to make sure that we harness the conviction, we also have an overlay of ratings, conviction ratings on any company. So to any two companies that we might be looking at, we will always favor the one where the analyst conviction is the highest. Once, of course, we stress tested that conviction in rigorous research debates. So hopefully that answers your question, Thomas.
Yeah, it does. Thanks. And we've had a question about ESG too. Can you tell us what's your approach to that and how much is ESG a factor when you're picking stocks?
Yeah, so ESG is a factor in our assessment in a similar way that we're assessing other fields. So there are 4 fields that we're assessing when we're looking at a company. We're looking at industry risks, company risks, ESG risks, which is a question, and then portfolio risks. And it's a very structured and consistent assessment that we do. On industry risk, we want to make sure that we're looking at companies that operate in industries that are favorable to value creation. So we're using the same approach as Warren Buffett. We like to find companies that operate in industries that have good dynamics. On ESG, therefore, we're looking at 2 fields, governance and sustainability. For governance, we're really looking at companies that are well governed as being more likely to create more value for shareholders. And on that front, we will look at the board, the management, the remuneration, and the culture of a company. On the management, we'll look at things like management quality, management depth, breadth, management competence, management experience of managing through crisis, as some of the assessments. And as a rule, we only invest in companies where we rate the management quality as high. Then on the sustainability side, there are various fields. There's the environmental risks and the social risks, but we'll also look at whether companies have a good sense of sustainability in terms of how they manage that risk. And that's things like how they manage the risk to their physical assets. But we'll also look at cybersecurity. We'll also look at how they manage their customer trust, because if a business can't generate the trust of its customers, it's not going to have a long-term business. I mentioned cybersecurity. That's another area. Tax as an approach. How do they manage the tax across their different aspects? So really what we're looking at is, are businesses aware of the challenges that their operations face in terms of sustainability? Do they manage those risks appropriately? Because if that's not the case, that can again impact shareholder value. That's how we look at it.
Thank you. Picking up on the answer about valuation discipline, and you discussed the scenarios you look at. Can you tell us a little bit then how you think about NVIDIA in that light? Because it's very interesting to see that you still have conviction in it after we've seen the emergence of DeepSeek in China that led to a lot of questioning about whether NVIDIA's position was quite as strong as you thought. So yeah, could you tell us a little bit about how you view those scenarios and why you're still confident in NVIDIA?
Yeah, it's a good question. So the way we look at a company like NVIDIA is we do have these various scenarios, and indeed DeepSeek is an episode that got us to look a bit deeper into some of the threats. Now, we were aware that there could be potential risk coming through from China, and that is part of that theme that I mentioned within AI, which is technological and geopolitical fragmentation. And I'll come back to that in a moment. But back to NVIDIA, as we've been assessing the leadership of that company, we've actually concluded that if anything, the leadership that it has will continue to be sustained and in fact potentially accelerate. And that's partly because of the scale advantage that they have now got themselves into, given the size they are. Their R&D budget is significantly superior to all its competitors. And we believe, therefore, that it can channel more dollar amount to remaining innovative and continuing to deliver vastly faster GPUs, which should permit it to continue to have that position of quasi-monopoly. Although I will also say that we are modeling for the company to potentially get to a scenario where their market share erodes from the 95% plus of GPUs to closer to 80%. And even then, we think that their growth profile should be able to make the company continue to compound attractively. In addition, when we're then looking at where market estimates are in terms of the AI opportunity, we think that that AI opportunity is underestimated, both in terms of speed at which it's coming through, but also the overall size of that opportunity. And that's why we've remained very invested. On the potential size, we believe that the market has still not started to discount the potential for AI demand to increase due to what is called sovereign AI, which we're now just starting to talk about and hear about. And this is something that isn't in estimates, and we think that that can also be supportive for the company. So in a sense, we still expect the company to continue to have good momentum. When you look at the quarterly earnings, it has continued to beat estimates, and consensus has consistently had to upgrade their assessment of the earnings power of that business. And we believe that that could remain the shape of things to come for the time being. And so when we then fit that into our valuation, we still see upside on our price target, which then justifies us staying invested, and our conviction remains high, which is why we've remained invested in size.
And is sovereign AI, that is governments building their own AI systems, is that right?
Yeah, that's correct. And that therefore brings us quite nicely, Thomas, to the point I was mentioning I would come back to, which is that technological and geopolitical fragmentation. So that for us as a theme is the whole dynamic around Taiwan and the China and US tensions around Taiwan and the potential risks related to that. But that's leading to that technological fragmentation. And arguably, we have seen that with DeepSeek, where clearly with what DeepSeek has shown to the world earlier this year, it is highlighting that the technological fragmentation that has been imposed on China through this leading edge semiconductor technology restrictions that have been imposed on the country, that there has been ways to continue to progress and innovate without having access to leading edge technology. And that really highlights that the AI race in itself will be an important continuing focal point for governments, and therefore that sovereign AI will be an important area of spend.
And speaking of races, sorry, we had a question about Ferrari. The questioner is asking about, I think the question is really about how it fits into the EV revolution. So it's quite a big holding for you. Obviously, you've got climate change as one of your themes. How is Ferrari positioned in the EV world?
Yeah, in the EV space itself, our view is that Ferrari will be slow to move to an EV offering or a full-fledged EV offering. But when they will make that transition, it will be a product that will be significantly superior technologically to the rest of the competition. It has to be said that so far, Ferrari, if anything, is slowing down its transition to EV, partly because it is listening back to its customers, and the customer appetite is nowhere near as strong as even what the company was expecting. Which brings us to the reason why we hold Ferrari. Ferrari is a company that has very desirable products, very highly recognizable. It therefore has very strong pricing power, and it has shown that it can use that pricing power with every new model launches, with launches of limited edition products, which tend to be priced at $1 million for the first one that they've launched a few years ago, $2 million for the second one that they launched in the last couple of years. And we think they're going to keep pulling that pricing lever. And these models tend to be pre-sold before they even start production. They tend to be very high profitability enhancing to the company, as well as actually filling the production lines at times when there might be a cyclical air pocket, like was the case during the COVID initial crisis, when they were speeding up the delivery of this limited edition and therefore able to deliver on their expectations and on market expectations, or in fact over-deliver. So really, when we look at Ferrari, we think it's a very predictable demand. It's because it's got long waiting lists, and yes, in a cyclical downturn, those waiting lists might reduce, but they're not going to disappear in our view, which means that therefore the company is likely to continue to deliver on its top line and will continue to increase its return on invested capital through that pricing power. We in fact qualify Ferrari as a consumer staples rather than a consumer discretionary. And yes, it's a consumer staples for high net worth individual, but really what we mean with this company is it's one of the most predictable holding that we have in the trust, in our view, despite being seen as a high ticket item and highly cyclical.
Interesting, thank you. I've got one more question from the audience now. So if you're there watching the webinar and you have another question, please do put it now, because we should have enough time for that too. So there's a question about what you've done to the portfolio since the beginning of the year. Obviously, it's been a very volatile year economically, geopolitically. Have you made any significant changes in the light of what's been going on?
We haven't made any material changes to our exposures, and actually that brings me to some of the top-down exposures. Now, we're looking at each stock on a case-by-case basis, and because of our valuation discipline, we have been finding more valuation support outside the US. So the trust has, for some time now, been very underweight the US, and on the other side, we've been very overweight, notably European stocks, because that's where we've been finding more attractive valuation support. And that that exposure has remained directionally similar, where we're still very underweight the US equities, very overweight Euro. We've been looking at opportunities to gain exposure to some areas of Asian equities, in particular, emerging markets. When you look at some of the valuation support has become very attractive, and that's where we've been pointing some of our research efforts, notably around Chinese equities, on the basis that as we're getting into this event where the US and China are talking about potential tariff tension de-escalation, that could create some supportive backdrop for some of the companies that are operating there. So companies like Tencent or Alibaba are companies that we've added over the past couple of months with a view to being invested in businesses that ultimately have had a very supportive ROIC, but where the macroeconomic backdrop of China has not been that supportive over the past 3 years, but that we believe could be more supportive if we have a positive resolution between China and the US. So that's been an area where we've shifted a little bit some of our exposure.
And any direct or indirect exposure to China? Any change or view on that?
Yeah, what we've done has been to sanitize the portfolio of some of the holdings where we had a weaker and weakening conviction. So we exited names like Kering in the luxury goods space, Pernod Ricard in the spirits segment. And these are companies that are fairly exposed to China indirectly. We exited Estée Lauder at the back end of last year. And that, again, has been a name that has had headwinds from a weak Chinese consumer. But also, when you compare it to L'Oréal, has clearly shown that it hasn't navigated those China headwinds as well as L'Oréal has. And therefore, our conviction on that name weakened. So really what we've done actually since the back end of last year has been to take a harsher look on some of the stocks where conviction has been weakening and really questioning their potential to be in the trust, and therefore I was using the word sanitizing the portfolio of some of these lower conviction names. We've taken a much more aggressive approach to exiting some of these areas.
We got a final question. What kind of retail investor are you trying to attract, or do you think you're suited to?
It's a good question because our style is very clearly defined as quality growth. So for retail investors, what the awareness has to be is that there will be some phases in the market where the trust will not perform, especially if it's a market that's led by value rather than quality growth. And for us, it's really about the time horizon. We believe that on that 5 to 10 year time horizon, if we focus on finding companies that have attractive growth profile, that generate high returns on invested capital, and where the valuation discipline that we take means that we buy them at an attractively valued entry point. We believe that if fundamentals do get delivered, and once the market does focus on fundamentals, those companies should re-rate. So we would say that the retail investors that we focus on are those that do want exposure in their investments to this type of companies, quality growth companies, which is what we listed: leaders in their space, low risk of disruption, exposure to structural growth. And therefore, that can also be resilient in downside economic cycles, but more importantly, that can compound over time. And our belief is that as markets go back to a focus on fundamentals, at the moment, it's still very much headline driven, policy announcement driven, macro driven. But once we get that focus on fundamentals, we believe that these companies will appear attractive to many investors, and that will lead to the re-rating.
Brilliant. Well, that's 2:45 exactly. So we've done very well on that regard. Thanks very much, Zed, for your presentation and your answers to the questions. And thank you very much to our audience for your interest. Hopefully the slides and the recording should be up on our website very shortly. And if you have some time, we'd love for you to join us tomorrow. We will be hearing from Sequoia Economic Infrastructure Income Fund. So, Zed, thanks very much. Hope you enjoy the rest of the good weather. Have a good afternoon.
Thank you.
All right.